Vaughan, thanks for finding time to talk to us tonight about the construction sector, where the views are as varied as the number of companies available in that sector. Top line, what's your view on construction?
Look, we're positive, Godfrey. I mean, I must distinguish. Our construction analyst, Roy Campbell, is probably a little bit more defensive than we are.
Why is
I
that?
am. Primarily because, you know, the key issues, you know, the investment is such that Murray's is disappointed. You know, the whole construction sector went through a very big boom period, and now there's a sort of a little bit of a hangover. But, you know, our viewpoint is that if you look at the market, there's not that many opportunities for alpha. You know, typically the market is typically overweight commodities or commodity stocks, probably more neutral on financials, and then industrials, it varies. So in our mind, you know, you've got to look at where the potential opportunity is. And we did some work recently which showed that it is a late cycle play, and typically when you start to get interest rate hikes, that sector, particularly the long history that we have for sort of Murray's and Avenge, outperforms on a 12-month basis after the first rate hike. Now, Kevin will probably jump in here and say, well, maybe the first rate hike is going to be a little bit later than the sort of September that Michael Cave, our economist, thinks it's going to happen. But typically, you know, the longer rates stay lower, obviously the better for this kind of sector. So we are more positive. Our construction analyst is a little bit more conservative than we are.
Vaughan, isn't there some risk with that? And I agree with the basics of what your analysis is. Can we just chat around the timing of it?
Absolutely.
Ignoring the interest rate debate, isn't there some risk that in looking at the market, you're finding the construction sector is kind of the cheaper part? And therefore, because it's the cheaper part, you're saying, well, let's recommend construction, whereas it could remain cheap for some time. In other words, you're going to need a little bit of a catalyst to get that re-rating. And that catalyst is obviously more capital expenditure, Transnet spending their 110 billion, all of these things. Is not the risk in what you're suggesting that you're too early?
Absolutely. I mean, there's entirely that risk, and it's actually a very good point. You know, you would probably step back and say that our view tends to be maybe a little bit more longer term. And if you look at the other component of construction, the residential sector, I think we're all in agreement it's in a very tough patch at the moment. You know, the upper end's very, very tough. But, you know, the converse is that after 16 years of democracy, we could almost feel that the Eskom issue just highlighted us to some of the challenges that we have for our infrastructure. And it's almost the user will pay, because we absolutely need it. You know, the next thing coming down the pike is the roads, after which we're discussing right now, the Gauteng freeway improvement project. I'm almost certain that we are going to be paying tolls. You know, we need this infrastructure. Government doesn't have endless supplies of money, so the user must pay. You know, we can debate some of the background to it, but I guess the user's got to pay. The water is the next issue that's coming down the road. All of this is going to end up in infrastructure, and the only guys that can actually put this together are the construction sector. So maybe we're going to be a little bit early, but equally, you know, the kind of analysis that we've done, if you're getting 30 to 40% of excess return on a 12-month basis, I'm prepared to sort of lose the first 6 months, particularly when they've done so badly. So I think you're absolutely right. Valuation is a key component to it, but you've got to look at the potential.
But when are you pricing in that first hike?
Well, our official view is September for the first rate hike. Kevin, I'm not sure exactly what your view is. I think the market is sort of split, certainly on the sell side, between September, November, and the early part of the year. The early part of next year. But again, if you're going to miss it by 3 months, does it really matter?
Vaughan, you seem to, the way you're talking about...
Kevin, before you come in, when are you pricing that first hike?
Early next year. We're
early
saying
next year. So you're different from where he lies, hence your question around whether
the timing
actually
of
you
it,
could be early.
We feel that the economy is still a bit soft, and we're going to have a petrol price decrease next month. So that's some good news, probably in the order of 30 cents or more. So the pressure isn't quite as bad in terms of inflation that we were worried about a couple of months ago. So we've pushed out the interest rate expectation till early next year, but we still think there's going to be a rate hike. What I'd be interested in knowing from Vaughan is your view on the market in general. I mean, you're saying that construction is an opportunity, basically because the valuations are in its favor, but the market overall, what's your general view on our market?
I mean, that's a nice question, Kevin. You know, we favor a longer term metric. There's a Graham and Dodd P. You take the current price and you divide it by the average of the last 10 years earnings. Internationally, it has an R-squared of 65%, which is pretty good. And typically it explains the longer term view. If you went back to South Africa 10 years ago, our Graham and Dodd P was around about 24, which would have inferred, you know, single 10% compound growth rate over the period. We had significantly better than that. But that was a bit of an anomaly because at the very same time we had this massive commodity run. So we're sitting now looking at around about a 24 gram and odd P, which in our mind means in the next 3 to 10 years you're going to be looking at below trended growth. So maybe around about 10%. Our long-term historical returns are around about 18%. So we don't think that the market is super cheap. And we think sort of below trend longer term growth rates. So in that context, we're looking for opportunities, but our basis is not, we're going to shoot the lights out in the next couple of years.
Yeah, let's talk about your asset allocation now. Yeah, now the RMB house view is you overweight cash and you underweight equities. That's
correct, but that's a tactical position. What you typically find is that this time of the year, your equity market typically gets about 75% of its return from around about October till May. And about 25% from sort of May till October, November. So we are being a little bit tactical because obviously the alternative assets are cash and you've got bonds, and neither of which is looking particularly exciting for the next the next year or so. But that is truly a tactical viewpoint. We went actually overweight cash in the beginning of June. We've been lucky that it's actually worked for us.
Vaughan, how would you be playing offshore versus onshore? What would be your advice with regards to offshore component at the moment?
Unfortunately or fortunately, we are pretty much consensus. We are almost a limit up on offshore, The view being then, again, if we go back the last 10 years, the rand has effectively been flat. It's gone from 7 up and down, but back to 7. We don't think that that's necessarily sustainable, but I don't want to jump into your area, really. So we take that into account. But, the offshore, again, if you look at the offshore relative valuations, relative to South Africa, the S&P 500, you could argue could be looking at about 7-8% return, and then you've got to decide on the rand. So the rand typically doesn't stay flat on a 10-year view. So.
And within sorry, Godfrey, within that offshore, would you be favouring emerging markets at all, or is it an MSCI global index? How are you weighted? How would you advise people to be weighted offshore?
It's typically MSCI global. I mean, if I think of our strategists, our global strategists and our EM strategists aren't really that positive, and they're aiming for a better second half. I mean, I think Jonathan Garner, our EM strategist, is saying, until China stops hiking rates, one has to be a little bit careful. So he's calling for a second half of the year. So we might go a little bit more emerging market at that point in time.
Vaughan, unfortunately, we've run out of time. But before I let you go, Bronwyn actually promised a viewer that you were going to give them your target price for Marion Roberts.
Well, I might have to be very careful about that question because it's not my target price. It's our analyst, Roy Campbell. It's in the region of 28 rand, so there's definitely upside. But we certainly think we're optimistic on Marion Roberts.
One could be in trouble for voicing doubt about the house view.